Sustainable and responsible finance is emerging as a necessary facet to the way we raise capital and facilitate ethical investing in our investment philosophy and processes. While many agree on the need to do so, they lack a systematic approach which is widely accepted today. It is with this backdrop that we are most honored today to have Professor G. Eccles sharing with us the topic, the relationship between the Sustainable Development Goals and Islamic finance. Ladies and gentlemen, let's welcome our keynote speaker, Professor Robert G. Eccles. All for you.
So thank you, Norifa. Can you hear me okay? There's some stuff I'm going to do off before I go up here. Those of you that were here yesterday know that I was here Tuesday. I'm still not in a very good mood. I'm getting over shock. That's what happens next. I'll see. The events actually of yesterday will tie into the time. But I'd just like to point out something, and I'll let you make the appropriate interpretation. I'm just going to give you some facts. You decide what they mean. So every year there's these rankings at universities, and historically Harvard and MIT have been ranked number 1 and number 2. And there was a ranking that was done a couple of months ago. And Oxford now ranked number 1. Oxford is the number 1 university in the world. That ranking came out after Dr. Norifa and I got our appointments at Oxford. Now I'm just saying, those are facts. What they mean, I'm not sure. I'll let you good people decide for yourselves. 2 other quick things I want to do. Again, those of you who were here yesterday, and I promised Norifa I was surprised, I talked about the fiduciary duty of boards of directors. Norifa asked me about Malaysia, so I pulled out the Malaysian memo last night. It was written by Asmi and Associates, and I cannot condition the memo. I'll be real quick on it. So the question is, who are directors' duties generally owed? For those of you who were here yesterday, the question is, what is the fiduciary duty of the board of directors? I mean, it's a really, really important question for all of you to care about. And there's the belief that the board of directors has to put shareholders first. My contention, backed up by a lot of the legal memos from all G20 others, is the duty is to the company. In Malaysia, the director of a company, you want this one, generally has a duty to act bona fide for the benefit of the company as a whole. Okay? Then it talks about the best interest of the company, the common law position interests of shareholders, other than stakeholders. It gets more nuanced. There are no required recognitions in company law and listings. It's the Companies Act of 1965 that these data come from. There's no positive obligation to take into account company's social or environmental impacts or the respective stakeholders. So in that sense, it's like U.S. law. Brazilian law and UK law are different. They will say that there is a positive duty to other stakeholders. It does say quite explicitly, do not have a duty, but they can. If they think it's in the best interest of the company, directors can consider impacts of these other issues on the company. And they do this under the exercise of reasonable care, due diligence, discretionary powers, and conflicts, avoiding conflicts of interest. So I think it's within Malaysian law, I think it's fairly clear that boards of directors of listed companies can take the material sustainability issues that would affect corporate performance into account. Another quick thing I want to share is I get up early, so I was up at 5 a.m. Starbucks opens at 5:30, if you want to know, on Connecticut Avenue. I was the first one in there. So there's a group called URICEF, which is an association of responsible investment funds, and they do an annual report, and I wrote the foreword for it, and they sent me the link this morning. So it was in Brussels and they announced it. And there's some data here that are quite interesting. And again, I'm going to go through this fairly quickly, and I don't know how to put this stuff on a PowerPoint, so I apologize. But there's this issue of how do we define socially responsible investing, because there's a bunch of different terms. What they've done is try and come up with a taxonomy to address that. And what you see is exclusions is the category, so it's basically negative screening. I'll talk about negative screening as the largest. And in the last 2 years, it had a compound annual growth rate of 22%. Norms-based screening is second, 18% CAGR, engagement and voting 14%. ESG integration, which is a particular interest of mine and what Arabesque Partners does as an ESG quant fund, 18%. Best in class investing, 18%. Sustainability themed, very small, very big growth, 57%. And you're seeing funds like Norges Bank Investment Management putting out mandates for themed investments like around water and so forth. And then the biggest growth rate on the smallest base is so-called impact investing at 120%. And I'm not going to have time to get into the details of impact investing, but this question of impact investing, and is it going to remain a fairly small niche done by sort of small impact investing funds, or can actually impact investing become something that is broadly speaking across all asset classes and the traditional managers, I think is the question that we're addressing, and that's going to be important for the Sustainable Development Goals. So let me tell you, I want to be fairly crisp here because you've got a lot on your agenda. Let me tell you the punchline. So here's the punchline. The punchline is a question which I don't have the answer to. The question is, are the Islamic finance capital markets large enough today, or can they become large enough with the kind of initiatives that Noripa is talking about in the United States to have a meaningful impact on the Sustainable Development Goals? That's the question. The logical linkage between Islamic finance and the Sustainable Development Goals is pretty straightforward, and I'm going to just touch on that. One of the reasons I'm going to just touch on that is that it would be boasting if I called myself a neophyte in Islamic finance. I'm not even at the stage of being a neophyte. I've learned a lot from some gentlemen in this room, so there's some experts that I'm going to call out, and they can kind of grab you during your panels and breaks. So getting myself off the hook here, you know, Kabir. So there was a great conference at Harvard that Saif Mohammed put on with some colleagues of his. He's a private equity lawyer guy here in DC, does private equity deals. We want to get a private equity guy. So they put on a conference, and I had the pleasure of moderating a panel of terrific people. Professor Kabir Hassan, who's sitting up here, gave a magnificent, truly magnificent talk on the relationship between Islamic finance and Sharia law principles and the SDGs, and I couldn't come close to replicating that. There's another gentleman who I think will be on a panel later today. I don't see him in here. Khaled El Sayed, who talked about kind of at a system level some of the treacheries of debt, quoted Einstein saying that the most powerful force in the world was compound interest. And then last night, I had the pleasure of having dinner with Mr. Mohammed Donia, who will be speaking later today, who's on the advisory board of Arabesque and has his own firm, Ideal Ratings. And I'm going to talk a little bit, without letting the cat out of the bag, about something that I took away from this conversation that I think is relevant. So what I'm going to do is kind of really just set context and paint what I think the opportunity is and the challenge, and then leave you with a question of, to what extent can Islamic finance help us address this challenge? I asked a question at the start of yesterday, how many people had heard of integrated reporting? Wasn't a lot. Let me ask a different question. How many people have heard about the Sustainable Development Goals on that? So a little bit more than integrated reporting. So think of this as kind of a primer on the Sustainable Development Goals, and then I'm going to say, as I said, show that there's a logical linkage between them and Islamic finance, and then kind of pose the question of whether Islamic finance can be big enough and powerful enough to have an impact. So I want to talk about two organizations that are important. I may have mentioned them yesterday. The first is something called the Principles for Responsible Investment. And it's an organization that was started about 10 years ago by the UN Global Compact, and I think it was UNFFI. It's a membership organization of asset owners, asset managers, and service providers. and it's an NGO. It's based in London, and what they do is that they sign on to these 6 principles. Incorporate ESG issues into investing analysis, ESG, environmental, social, and governance. I talked a lot yesterday about kind of what that means, the importance of materiality, how ESG issues are sector specific, getting appropriate disclosure by companies. This company disclosure thing was my main focus yesterday. I'm going to touch on it again here. Work together to enhance the effectiveness. Be active owners. This active ownership thing is important. It was one of the categories that I read out to you. This is an area where I'm ignorant in terms of Islamic finance. I don't know if there's this component of active ownership, and I'm going to kind of raise that a little bit further on. Promoting acceptance of these principles and reporting on activities and progress towards implementing the principles. The PRI made a fairly big step a couple years ago. They've had a voluntary disclosure of how they're implementing these principles, and they kind of tightened that up to sort of get away from greenwashing. So think of the PRI as the investment community. Yesterday I talked about the importance of the investment community, the corporate community coming together, taking a long-term view, incorporating the material, environmental, social, and governance issues into their decision-making process. Key organization here for on the investor side would be the principles for responsible investment. One of the objections to sustainable investing, by whatever name, the mythology, just like there's a mythology around boards of directors, was that if you did socially responsible investing, you were giving up returns. That you were doing things that were good for society, but you were going to give up some financial return in doing so. So that in some sense it was going to be a transfer payment to groups, to social causes, to environmental causes. And that's been a general perception for a long time. Evidence continues to mount that that's not true. Studies that have been done between socially responsible investment funds and traditional funds, it's kind of a wash, neither sort of better nor worse. So there's no clear disadvantage. I did a study, I can make it available to you. It's a very technical study with some of my colleagues at Arabesque, where we constructed portfolios and then we did screen of these portfolios based upon ESG criteria. And what we found basically was that there's the concern, one of the concerns around doing screening in sort of modern financial portfolio theory is that you will lose diversification. And when you lose diversification, you're going to increase your risk and you're going to reduce your returns and you may introduce more volatility in your portfolio. And through a variety of analyses with different portfolios that we constructed, which I won't get into, we found that that was not the case, that there was no negative effect from the screening, reducing diversification. In fact, in most of the portfolios we put together, we had an actual outperformance in financial returns. And in a sense, it's kind of logical, right? If you're screening out sort of bad companies doing bad things, eventually that's going to catch up with them. And so what we see is research continuing to mount that you can do socially responsible investing, you can incorporate environmental and social governance issues, you can actually get a better return. Arabesque does this as a quant fund, you can do it as active managers, and there's other strategies. So the UN Global Compact was started before the PRI. As I said, they were one of the founders of the PRI. The founding executive director is a gentleman named Georg Kell, who had been Kofi Annan's speechwriter. And it's an interesting story. There was basically a line in one of Kofi Annan's speeches about how the business community contribute to sustainable development. And it was some time ago, and it was considered to be, by a lot of people in the UN community, kind of controversial that business could actually be a source of solutions to problems rather than looking at business as the problem itself. That one little line in that speech, and it led to the formation of the UN Global Compact. And it has now about 8,000 members around the world. Companies join. It's a voluntary basis, obviously. What they commit to do is to adhere to 10 principles. And I'm not going to read all the principles up here. You can see them. I'm happy to make the deck available. But broadly speaking, these principles fall into 2 categories, or excuse me, 4 categories. It's human rights, it's labor, it's the environment, and it's anti-corruption. What the Global Compact asks its members to do is to publish every year the so-called communication on progress, the COP report. It could be an integrated report. It doesn't have to be, where in their communication on progress, they describe what it is that they're doing to be in adherence to these principles of the UN Global Compact. So you have the UN Global Compact establishing principles around, let's use the word sustainability. For companies, you've got the principles for responsible investment, doing the same thing for investors. Then we come to the Sustainable Development Goals. These were ratified, I think at the end of 2015. I guess they were formally announced. They follow on, if you're familiar with the Millennium Development Goals, not much ever really happened with the Millennium Development Goals. So all the member states, the 194 member states in the UN, end of 2015, early 2016, ratified, and I'll show you the list in a second, these 17 Sustainable Development Goals. So all member states, all countries, north, south, east, west, there's 4. There's nothing binding in this. It's on a voluntary basis, but the expectation is that countries who ratified these goals will come up with what their plans are for what their contribution is going to be. One of the differences between the Sustainable Development Goals and the Millennium Development Goals is that a lot of work was done to establish metrics, to measure the extent to which the Sustainable Development Goals, and these goals are for 2030, are being accomplished. There's 17 Sustainable Development Goals. Over here, I can look at a few. No poverty, zero hunger, quality education, quality of water, land. A fair question to ask, which hasn't been addressed, I've raised this with people, is can you accomplish all 17 of these things? Because there's trade-offs. Typically, you find there's trade-offs between social objectives and environmental objectives, and so kind of an open question. The business indicators, there's 169 business indicators. So for these 17 Sustainable Development Goals, there's 169 business indicators. That's a lot. So you might ask, well, what's the relationship between these business indicators and things that, if you were here yesterday, like the recommended key performance indicators from the Sustainability Accounting Standards Board? They're related to each other, but they're different. And you can think about it this way, that the SASB standards are basically a company's performance on environmental, social, and governance issues, where the unit of analysis is the company. When you look at the business indicators for the Sustainable Development Goals, the unit of analysis is really society. So it's framed more in terms of impact. So you can think of SASB, you can think of GRI, more SASB, I guess, than GRI, is kind of outcomes. And what these business indicators are impacts. So you've got 190 countries, all signed on a voluntary basis. Obvious question, if Mr. Trump is talking about walking away from COP21, and can you do that? Reading about that this morning at 5 a.m. Interesting, distressing question. This is not even on the agenda. These Sustainable Development Goals, I think, are as critical as COP21, and they still don't have the same kind of visibility. What people say about the Sustainable Development Goals and the numbers estimate, who knows how accurate it is, you hear different numbers. A number I hear, the beer would know better than me, is $7 trillion a year will have to be invested to achieve these Sustainable Development Goals over this next 15, 16 years. The thinking is that maybe a third of that $1 trillion can come from the public sector, and the rest is going to have to come from the private sector. Organizations like that are members of the Principles for Responsible Investment, which is the 23 trillion, I forget the latest number, but substantial. And as I said, the question on the table for this group, for you all to think about throughout the day, is how much of an impact can Islamic finance have? Because it's well positioned to do so conceptually. Whether there's the amount of assets to do that, as I said, I just don't know. So when I say he's not going to like this, but I got to say this. I just got to be honest about this. I went to MIT as an undergraduate, and I got my, he knows where I'm going with this, and I got my PhD at Harvard, and so we had this conference at Harvard, and, Kabir knows this as well. Technology didn't work, and these guys are like fumbling around, for 30 minutes to try and get the projector to work so that I could show my little deck, and they never did. I said, Saif, if we did this at MIT, the problem would never have happened, and if it did, there'd be some undergraduates sitting there in the audience. 30 seconds, they'd be up there, and they'd have the thing fixed. So it finally got fixed, for Professor Son. That was good because he has some other things to say. It got fixed at the end, so I said, I've only got one slide that's really important. And it's funny how context changes, because the slide that I'm going to show you, I sort of put it in there as like a little joke. It was kind of funny, back in October. And since Tuesday, maybe it's not so funny. But here's this cartoon. Energy independence, preserve our rainforest, sustainability, all these good things. This person says, what if it's all a big hoax? And we create a better world for nothing? And that's kind of more the temper of the times where things seem to be going. What? We do all this, we get these outcomes, and it's all for nothing. Why do we even care about it? So that's something for you to think about. There's interesting NGO in the UK called Share Action. I mean, it's interesting to see how much has already taken place in terms of people in the investment community thinking about the Sustainable Development Goals. So this group, Share Action, went out and did a survey of the PRI members, and they got a pretty good response rate, 10%, and it was, I forget, 7 trillion or something like that. And the question was, how did these big asset owners and asset managers think about what the Sustainable Development Goals meant for their business as investors? So 56% of senior leadership saw them as relevant to the organization. 44% is relevant to the investment team. So it's what I talked about yesterday. At senior levels, people tend to kind of get it more than you work down the organization. 62%, almost 2/3, thought that the Sustainable Development Goals created investment opportunities. So this would be an example where there's financial returns that also will have impacts that can be measured through the business indicators. 3/4 were already taking action on 3 or more. And importantly, they were working with various members of civil society. That slide I showed you at the end, I said, what we're talking about here is a movement. We can't look to regulation. We can't look to the public sector to solve these problems for us. It's companies, it's investors. Public sector clearly has a role, in NGOs. And NGOs are becoming increasingly effective. That's one of the interesting things that happened over the last 10 years. They're sophisticated, and they know how to engage with companies. Increasingly, they know how to engage with investors. Where the NGOs are and how they fit into the Islamic finance community, I don't know. But I think NGOs are clearly an important player in this regard. So there's 17 Sustainable Development Goals. You have to pick your shots, right? 17 is a lot. And depending upon the asset class, some of these Sustainable Development Goals may be more interesting than others. This is interesting. They asked them basically to rate the importance of the Sustainable Development Goals for their investment strategies, right? For their investment strategies, not in terms of do you think this is a good goal or not, but where, the extent to which you think there's, in the Sustainable Development Goal, there's opportunities for you as an investor. And I don't really have an interpretation of what it means, but here basically infrastructure and decent work and economic growth, climate action, surprisingly clean energy, and quality education. So question again for the audience is, what would you do to save lives? And would it be another group? And then there's sort of the bottom, reduce inequality, sustainable cities and communities, like no water, no poverty, partnerships for the goals, interesting. The investment community is basically saying we don't see as many opportunities for us there as we see in these ones at the top. So the barriers to having the private sector assist with the sustainable development goals gets to one of the things that I was talking about yesterday is you really need better data. You need greater transparency by companies so that investors have the information they need to know if the company says it's got a commitment to one or more of the sustainable development goals, what is it? How are they measuring what they're doing? What are the outcomes? How do they see these related to the business indicators, the impacts? And again, just continuing on the research, that you're not necessarily going to lose money. In fact, you can make money on sustainability. We did a study, this was before Noripon. I went to Oxford and they went from number 6 to number 1. I mean, that's just what happened. That's the sequence, right? We did a study with Oxford that was kind of a meta-analysis for both companies and investors. And on balance, what you see is that sustainability has positive financial returns. And then last year, there was a German group at a German university that did sort of a meta-analysis of meta-analyses that looked at something like 2,000 studies. We looked at 200 studies. They looked at 2,000 studies. You had the same thing come out. So I'm getting close to wrapping it up. You can see where this is going. You all know this better than me. I find this interesting. Sharia law protect the well-being of people. I mean, that's the sustainable development goals are about the well-being of people and the well-being of the planet, with the two clearly related. The well-being of the planet is going to affect the well-being of the people. Faith, lives, intellect, offspring, and wealth. And it's interesting, as I said, that you can see the logic lining up behind it. You know, the managing director of the IMF, Christine Lagarde, says the principles we're fighting for are very well inscribed in Islamic finance. So it makes sense. Got this graph from Mr. Donia, some work he's done, his firm, looking at the relationship between sustainable investing and Islamic finance, looking at what the basic principles are. And it's interesting to see where there's overlap and where there's not. And the question is, should there be more overlap? So the clear overlap is negative lists and exclusions. So our global equity product, the one that Arabesque has, is Sharia compliant. We have screens for doing that. We don't have banks, we don't have alcohol. So it's Sharia compliant, and you can do that. We're helped by this with Mr. Donia. So the screening thing happens in both sustainable investing and Islamic finance, but then there's some big differences. Clearly, the avoidance of debt and leverage. The zakat, you don't have that at all in traditional finance. And then this notion of instruments linked to real assets. That was one of the most interesting things that I learned in my sort of early journey into Islamic finance, this linking it to real assets. And then this issue that Mr. El Said, who will be on a panel later today at the Harvard conference, when he had just some dramatic data showing how the debt markets and then these instruments created on top of debt markets have created this sort of toxic stew. And we've seen this happen before. So this avoidance of debt, again, the question is there a way that Islamic finance, you're talking system level stuff here when you're talking about leverage. So Islamic finance cannot use leverage in the same way, but are there principles that can be taken from Islamic finance that can be applied to traditional Western financial instruments that will have sort of system level benefits? Then there's a whole bunch of things over here that are part of ESG that really aren't part of Islamic finance. Looking for companies that are best in class, proxy voting, kind of activist shareholders, engagement. The engagement thing is really important. You can see the other things here. again, I don't know the answer, but the engagement portion is really critical, because what you see in the Western markets is this trend towards passive investing. So active investing is going down, passive investing, indexes and so forth is going up, lower price points. The people that are doing the big chunk of passive investing, the enormous firms like BlackRock, the position they're taking is to say, well, just because we're not going to sell your stock because you're in this index, we're going to own it, doesn't mean we're going to ignore you. We're going to engage with you. So if you're doing things that we think we don't like, or you're doing things that we like that you think we could be doing better, we're going to engage with you. And the logic behind it is very interesting, because these really, really large asset owners and asset managers, they can't diversify away from systemic and planetary risk. So what their portfolios are doing, the aggregate impacts of the companies in their portfolios, are shaping the environment in which they're trying to get returns. I've written, it hasn't been published yet, I've written a 3-part series on CalPERS, the history of CalPERS. The image people have of CalPERS is like, well, those kind of activists, hippy-dippy people out there in California that, you know, name and shame companies, give them a hard time, right? Ann Simpson's a good friend of mine. She was the head of corporate governance now, sustainable investing. The story is actually very interesting, what they've done. Started with the financial crisis, $70 billion hole in their portfolio. It's going to take them 30 years to dig out of. They've got to get an average return of 7.5% a year. So the things that they're doing are all very hard-nosed capitalistic things, because they have a fiduciary duty to their beneficiaries. So understanding what the CalPERS story is interesting. They join a list of many other organizations that are saying, we need to engage with companies on their carbon emission policies. If they're oil companies, are they continuing to drill for oil in the ground that's a stranded asset that can't come out? What are they doing with respect to the Sustainable Development Goals? My question is there a role for more active engagement in Islamic finance? And is there a relationship maybe between this engagement thing and real assets? And again, I don't know. Last slide. So the Islamic Development Bank is on top of this. It's an interesting study. What they've said is, here's the major areas of contribution. They've kind of pulled out, you know, these particular SDGs. The financial stability thing I get, right, because of left leverage. Financial inclusion, shared prosperity, that all fits in with the well-being of people. My question, and I'll close, is, are the Islamic capital markets big enough today in terms of assets, or could they become big enough to be able to affect and to help contribute to the accomplishment of the Sustainable Development Goals, where we need, in round numbers, say, you know, $4 or $5 trillion a year from the private sector to accomplish these goals between now and 2030, in an environment where it's increasingly clear that, whether it's here or it's happening in some other countries, the public sector is not going to do the heavy lifting. It is what it is. The public sector is not going to do the heavy lifting, and so it's going to be up to the private sector. It's going to be up to companies. It's going to be up to investors. I think there's a great opportunity for Islamic finance. How big it is, don't know, but looking forward to learning more about it. Thank you very much.
Thank you, Dr. Eccles, and if you could remain on stage for a while. Now I would like to invite our two